Welcome to the weekly market update. I am the Options Overlord, and this is the market week ending Friday, July 31, 2026. Educate, discipline, execute. Let us get into it. First, the ground rules. Every week, no exceptions. This is educational content only. It is not financial advice, and it is not personalized to you. Options carry real risk and are not suitable for everyone. Nothing here is a recommendation to buy or sell any security. There may be tax implications to any strategy, so speak with a licensed professional about your own situation. Everything I show you is a framework for thinking, not a signal to trade. Accountability first. Every week, this channel sets a rule for the week ahead, and every week we come back and grade it in public. Last week, the rule was watch VIX 20 as broad breadth meets the FOMC and mega cap earnings, with a break above 20 and breadth below 55, signaling renewed risk concentration. The verdict held. The VIX finished at 15.99, never breaking above 20, and breadth stayed broad at 62%. Neither stress condition triggered, so the calm read was the correct one. The scoreboard, the S&P 500 closed at 7,489.72, up 1.05% on the week. The Nasdaq 100 tracker, QQQ, closed at 687.99, up 0.55%. The Dow closed at 52,485.03, up 1.04%. The VIX finished at 15.99, down 2.59 points. So the options market priced a weekly swing of about 2.2%, and the S&P actually moved 1.05%. The week came in inside what options were pricing, which means the market was calmer than the hedges expected. The regime map, one picture, four boxes. Where are we? This week, participation broad, index volatility low to moderate. Translation: most stocks are participating in the move, and the market is not paying up for fear. That is the constructive quadrant for selling premium against stock you already own, but it is also where complacency lives, so position size stays disciplined. The premium read, where the market is actually charging for risk. QQQ IV Rank 57.8, the highest of the three, and mid-range for tech. SPY IV Rank 16.6 and IWM IV Rank 12.7, both in the lower range, meaning option premium is the market pricing risk, not generosity. A higher rank pays more because more can go wrong. So read conditions, not tickers. If you want the free checklists I use before selling a covered call, the Covered Call Qualifier is linked below. What actually mattered this week? The lead, a Fed hold and an oil shock pressured risk. Stocks fell sharply Wednesday after the Federal Reserve held rates at 3.5% to 3.75%, while renewed Middle East attacks drove a surge in crude. On the sectors using the ETF proxies, consumer discretionary XLY up 6.1%, communication services XLC up 1.8%, financials XLF up 1.1%, then real estate XLRE down 1.9%, and utilities XLU down 4.2%. On rates, the 10-year sits at 4.75%, up 6 basis points on the week, and the 2-year at 4.28%, down 5 basis points. The takeaway, the 10-year yield rose 6 basis points while crude settled lower on the week, and the major indexes still finished higher. Risk watch, and this is the slide that matters most this week. The VIX reads 15.99, low to moderate. The scheduled item inside the next 7 days is the Employment Situation Report, Friday, August 7 at 8:30 a.m. Eastern, high impact. On the radar, dates to be confirmed, the PCE Price Index and the FOMC. As event risk examples this week, not trade recommendations, Eli Lilly, August the 5th, with an implied move around 7.3%. Advanced Micro Devices, August the 4th, around 10.4%. And Caterpillar, August the 4th, around 8.1%. The discipline, a calm headline VIX, is not low event risk, with payrolls, CPI and PPI all approaching. The Overlord Read, broad participation, lower volatility, higher indexes. The divergence, QQQ IV Rank held at 57.8, while SPY IV Rank was 16.6, and the VIX fell to 15.99. Why it matters. Technology-linked option pricing stayed elevated relative to the broader index, even as the headline volatility gauge went quiet. Put simply, the calm on the surface is not evenly spread. The market is still paying up for risk in tech, while charging very little across the broad index. So here's the rule for next week. Set now, graded next Friday. Watch the VIX above 20 with breadth below 55. Watch level VIX 20. Both conditions together would mark a return to concentrated market stress. That is the line in the sand, and we will score it in public next week, held or broke with the reason. The free Covered Call Qualifier is linked below. Thank you for watching. Stay disciplined. Let us go.